What's up YouTube, and welcome back to another YouTube video here on the Audacity YouTube channel. Today, we're going to go over the consistency rule in trading, and I'm going to give you a couple tips for that. Without further ado, let's get straight. Consistency rule in trading. Consistency is the number one rule every trader needs to master. Without consistency, no mentor or no strategy is going to save you. In this video, I'm going to show you what consistency is and what it's not. So let's speak over what consistency is. Consistency is doing the same things over and over again. It's not random trades. It is not chasing the market. It means following your plan no matter how you feel. The market rewards discipline, not impulse. Now we are going to go over why traders fail. Obviously, they are overtraded. They are breaking the rules and they have too many strategies. The thing is, they jump from one strategy to another. The last thing is, they are mistaking activity for progress. And it's definitely not the same thing. Consistency removes all of that noise. Here, I'm going to give you a few steps how to build consistency. Step number 1, have a journal. In this journal, you write down every trade, every setup, every emotion. Step number 2, define one strategy. Don't hop around. Master one approach first. Step number 3, set a risk limit and never break it. Step number 4, review your trades weekly. Step number 5, stick to a routine. Same day, same trade, whatever it is, stick to your routine. Now I'm going to show you 2 examples. First, I'm going to show you trader A. So what can you see here? Trader A wins big one day and loses big the another day. There are no plan, no rules. It's just count. You can see we're jumping to 3K equity curve, back to 1K, back to 3K, back to 500 even. And he's bouncing back and forth. Big wins, big losses. It means the count is unstable. Now, Trader B. Trader B takes small, steady trades. Small wins, small losses means steady growth. It's the same setup, same risk, same week. Now think about it. After 1 year, who is going to survive? Trader A or Trader B? It will always be the consistent one. Number 5, let's go to long-term consistency. Okay, now we are going to speak over long-term consistency. What you need to do is cut out the noise. Stick to your edge and don't listen to every guru on Telegram or Instagram or whatever. You need to accept that losses are part of the game. The real success is stay consistent, not trying to be perfect. Now let's talk about my own journey. In my own journey, I lost money because I wasn't consistent. I jumped between strategies. I risked too much. Once I became consistent, everything changed. My results improved. I got really confident. Consistency made me a trader, not luck. Remember, consistency is your goal to long-term success. Master your process and the results will follow. Okay, now let's talk about the consistency rule at Audacity Capital. It is one of the most important parts of getting funded. Many traders think it's only about hitting a profit target, but that's not enough. Audacity also wants to see if you can trade in control, consistent way. What I'm showing you here you can see 5 trading days. The first one, you made $500. On the second, you made $550. On the third, you made $480. On the fourth, you made $200. And on the 5th day, you made $1,200. And what it says is 1 big day equals unbalanced. And that is exactly what I meant with the consistency score at Audacity. If you have 1 big day like this here, you are not really trading consistently. On the other hand, what I'm going to show you here is multiple steady days, which equals stronger consistency. On day 1, you made $500. Day 2, $550. Day 3, $480. On day 4, you made $200. And on day 5, you made $450. And all of them are pretty equal here. So what does consistency actually mean? It means keeping your trades similar. Similar lot sizes, similar trade durations, and trading on at least 4 separate days. In this picture here, you can see a minimum of 4 trading days. On day 1, you made 2R. You were in the trade for 1 hour and 50 minutes. Day 2, 1.7R. You were in the trade for 2 hours and 5 minutes. Day 3, 2.1R. You were in the trade for 1 hour and 30 minutes. And day 4, 1.8R. You were in the trade for 1 hour and 40 minutes. Every trade here at a risk of 0.5%, which I said, you want to trade a minimum of 4 trading days. You want to have your lot sizes equally, and you want to have the trade durations pretty much similar. And this here is a consistent trader. So now, take a picture. He traded on 3 days. On the first, he made 2R. We're in the trade for 1 hour, risk 1%. Trade 2, 1.7R. We were in the trade for 2 hours and 5 minutes with 0.5% risk. And the third trade, we made 2.1R. We risked 2% and we were in the trade for 4 hours and 30 minutes. And that is what I meant. It's not the minimum of 4 trading days. The lot sizes are not equally or pretty similar. And the trade durations were not similar as well. So this here is an inconsistent trade. And what you need to understand is if you go big on one day and tiny on the others, you are not a consistent trader. It's more luck than skill. So now I'm going to show you how we are going to measure it at Audacity Capital. I'm going to show you how you can calculate your consistent score. So you're going to subtract from 1 your most profitable day. You're going to divide it by the sum of your profitable days altogether. And you're going to multiply it with 100. I'm going to give you a quick example. Let's say our most profitable day is $750. Now I'm going to give you the sum of our, in this case, 5 profitable days. It's 450 on one day, 750 on the next day, which is our most profitable day, plus 490 on the third day, plus 500 plus 500, which equal $2,690. So how to calculate the score? You're going to subtract it from 1, divide 750 through 2,690. Then you're going to subtract it from 1 times 100 equals a 72.1% consistency score in this case, which is profitable. Now I'm going to show you how you can read and interpret that score. Let's say you're going to trade on 4 days. Risk remains at 0.5 for every trade. And you can see that the outcomes of these trades here are pretty much equal. The score is 70% and you pay. Here you can see 4 trading days. The risk remains 0.5 with every trade as well. But you can see the third trade is really big. And that is what I said. If you go big on one day and tiny on the other, you are not consistent. This is gambling and that was pure luck. And in this case, your score is between 50 and 70. That means the risk team might ask you for more trading days to prove that you're profitable and that the one big trade was not just luck or gambling. Here you can see the third trade is a really big day. It's like third of the size from the first trading day. And what you can see is risk is not the same for all the trade, which means let's say 0.5 for the first trade, 1% for the second, 0.5 for the third again, and 2% for the fourth trade, which means that is not consistency. This is pure gambling. And the one big winner here was just luck. In this case, your score will be below 50, and that means that you need to keep trading until you reach a balance. So remember, consistency is not a rule. It's a proof of control. And that's exactly what gets you funded at Audacity Capital. If you found this helpful, like, subscribe, and share with other traders who needs to hear this. Let me know in the comments, what is the hardest part for you to stay consistent as a trader?